So my next guest remains cautiously optimistic with an emphasis on cautious, noting strong earnings revisions. However, also that these revisions are driven by just a few stocks and a few sectors. I want to bring in out Bank of America Securities Head of U.S. Equities and Quantitative Strategy, Savita Subramanian. And Savita, you know, in your last week's note, you pointed out something really, I love when you do these because I don't know the last time there were more. So out of 20 metrics,
yes.
we're overvalued in 17 of them.
Yeah, this is a pretty nerdy exhibit, but I think everybody always talks about the multiple of the S&P 500 being
right.
too high. So it is true when you compare it to the 80s or the 90s or the 2000s, the multiple is high. One could argue it should be higher because the market itself has changed so much, right? It's less levered. It's got these big, growthier businesses. But yeah, it's not. You can't sugarcoat it. Statistically, the market is still expensive.
I'm going to bring up the chart before this with the earnings revisions because everyone is talking about these earnings revisions, but some critics are saying, well, yeah, you've got earnings revisions, but it's really just two sectors, energy and tech. And it's really just maybe three companies, right? Maybe Chevron, Micron, Broadcom, and after that, so I mean,
sort of
how excited
out.
should we be about these earnings revisions?
Well, we've seen this movie before, right? We saw this at the beginning of last year. We saw this at the beginning of the year before, and it's this sort of idea that the market should broaden out, but there's no earnings support. Look, I think we're at a point where Q1 isn't necessarily what we want to look at. We want to look at the full year. Mm-hmm. What happened in Q1, it's baked. It's already in there. But we want to listen to guidance. And I think what's concerning to me, what makes me a little more cautious and a little less optimistic on the consumer is the idea that a lot of consumer companies are starting to talk about higher oil prices.
Right.
So however long this lasts is going to be that much more painful for the consumer. And the problem is we don't know how it looks because the numbers haven't hit. So in our work, we've found that there is always a pretty long lag time between when oil prices go higher and when when price at the pump is, $1 higher than it was a month ago. That is going to have a very lagged impact, maybe 3 quarters.
Right.
On when it actually hits, whether I buy a big ticket item or not.
But also with respect to the first quarter, you noted too that reactions weren't that great. I think this is the second quarter in a row because I thought the fourth quarter numbers were strong too, and it was sort of like,
meh, no reaction. And I think that's a sign of positioning, right? So you've got these companies that are crushing it, they're delivering big surprises, everybody's already there. How's the stock going to move higher unless there's a new buyer in town? So I don't really see a lot of new capital being committed to some of the old winners in the S&P 500.
The Bank of America number for the year is 310. The street is at 324. Do I have you right? Yeah, 7,100. Is that your target for the year?
Our target is probably amongst the lowest targets on Wall Street. And I think the reason is I don't see enough bears out there. I feel like we're all talking about earnings being great. I think earnings are going to be great, but typically years where you have the strongest growth and the strongest GDP recoveries are years where the market actually turns in fairly low returns.
Are they snake bit though? Because last year the street, all came in universally at the same place. The tariff situation happened. Everyone went down, and all of a sudden the market erupted, and Wall Street was behind, and it felt like they didn't want to take the bait this time.
Yeah, maybe. I mean, geopolitical dips should be bought, I guess, is the rule that we've learned. And, so far, so good. I also worry, though, I think there might be a little bit less dry powder with which to buy equities.
Right.
So when you think about, 2 years ago, the question we got all the time was, I have capital, should I buy the market today or should I wait for a better entry point? And we don't hear that phrase anymore because investors are more, kind of fully invested in the market.
Margins, though. Margin expansion, though, seems to me to argue maybe for a higher market. I'm of the school that believes the margins go this way, the market goes that way.
Yeah. I agree. But I think the margin expansion might not be in the tech darlings. I think it might be in some of these AI adoption stories. Like I love financials, I love
Right.
healthcare, I love these
Right.
companies that haven't really had an efficiency cycle, but could actually get out of their own way and use these new tools to get more efficient and to get leaner margins. So I think those are the
So then
vibes.
let's circle back to technology here
Yeah.
and the jobs market. Obviously, it's we had the SaaS apocalypse. I don't know if that's still happening. We had a
Yeah.
reprieve from it, but I don't think it's necessarily over. And that essentially, you say, you know what, go overweight staples, maybe underweight discretionary.
Yes.
And what are you doing with technology? You're standing off a little bit here?
Tech, we're equal weight. I think we're
Okay.
still in this very strong chip cycle. I think, everybody is building out capacity. I would buy cyclical tech, but I would be more leery around software and some of the other areas that could be disrupted. I also think that when you look at semis, we're in a CapEx cycle that's not just about AI, it's about everything. We're seeing build out of US manufacturing capabilities, and that's very bullish for semiconductors and for unit volume sales growth.
They've been absolutely, and they've been on fire. I got to ask before you leave, though.
Yeah.
A lot of excitement about these IPOs, right? We're going to just show some of these potentially hot IPOs.
Yes.
This is old because SpaceX is at 1.7, maybe.
Right.
Maybe it'll go 2 trillion.
Every day it's out of date, right?
Yeah. And there's a school out there that believes this is going to be exciting. Maybe people will take their money from their extra tax refunds. Whatever it is, they're going to find cash, even if it means selling stuff
Yeah.
to participate in this. For the overall market, is this going to be a net winner or could it actually be a drag?
Well, I think for certain sectors, like if you look at this chart, it's mostly tech, mostly media. For those sectors, all of a sudden there's competition. So I think the bull case that's kept tech going for the last, 15 years, cash rich, these were companies that were doing aggressive buybacks. There was less and less market cap to buy. It was the shrinkage argument where you couldn't really find that much publicly available growth equity.
Right.
Today, we're about to get flooded with growth equity. And
Yeah.
I think that's great in
Yeah.
the long haul, but in the near term, that's a supply drop that
Yeah.
could kind of kill the story.
I do get a little nervous, though, when the broker calls a client. Guess what, Mrs. Jones? You can get your OpenAI IPO. Like, huh? Wait a minute.
Yeah, exactly. We've seen this movie before, and
Exactly.
it's, I think it ends well down the road,
Sure.
but there's a period of absorption,
A
and
lot
that's
of
what I worry
absorption.
about.
Savita, thank you so much. Appreciate it.